Let's look at some of the different ways that you can use to get funding in between the development. So say for example, bridging loans. They are used to quickly move on to a deal, and they are typically refinanced after a short term with another lender, because usually they would come at a higher interest rate, and often used to obtain planning permits. You go in, you use a bridging loan to secure the land, and you get the planning permit, and then you move from there. And it comes from specialized lenders willing to take that extra risk. Very similar to bridging loan is also a caveat funding or caveat financing. Caveat financing is when a lot of someone wants money really desperately. They've got an unencumbered property. They go to a lender, and they are specialized lenders for this. Then they say, okay, we'll give you that. We'll put a caveat on your property, which is a consenting caveat, and the interest rate would be really, really high in that scenario. So it is only for a short-term period, and I mean, I don't think anyone can borrow on caveat funding and do a full development. It's only done for a couple of months, and you pay that, and you use that money, and then you do whatever you need to do once you've got your money source from other sources. So that's what bridging loans are. Again, mezzanine finance, very similar to bridging loans. This is when the debt capital that gives the lender the right to convert an ownership or equity interest in the company if the loan is not paid back in time and in full. So this basically is very similar to a bridging loan. Also, it does the same thing as a bridging loan. However, in this, the lender's got a right that they can convert whatever you owe them into equity, into your development, or the property that you are mortgaging. Usually they come in as a second mortgager. So it is used by developers to secure additional financing for development projects where there is a shortfall of equity required by the main or senior lender. So a senior lender might turn around and say, look, we'll only give you X amount of money, but you need it a little bit more, and that more, whatever you needed, whatever the gap is, can be funded using the mezzanine finance. So more expensive because it's secured by a second mortgage, and since it's second in line, that is, if something happens, first mortgage holder or the senior lender gets paid out first, and then the second lender gets paid. So they would have the second priority, and the first priority would be the senior lender, and that's why mezzanine finance also comes in at a higher interest rate. The third one is a non-recourse loan or debt, which is secured by collateral or real property, but the borrower is not personally liable. And in that sense that they can't actually go after the borrower. So it's usually the property and not the borrower. So if the borrower defaults, the lender can seize the property pledged as security, but the lender's recovery is limited to that property. That is, the lender cannot come after the borrower even if the collateral does not cover the full defaulted amount. Now you would say, which lender in their right mind would do something like that? But what happens is they only lend you 50% or 60% of the valuation. We all know that valuations usually come in a little bit lower than what the market value is. And imagine that they only lend you about 30, 40, 50% of that amount. So they are very, very secure. So they know what they are lending you and what they can recover from that property in case of a default. So that's property development finance.